If you bought just one of the 5 best stocks last year, you would have made an average return of 403.99%. That would have turned $100,000 into over $400,000, and it could have changed your financial future. So what were those stocks? You had Applovin, MicroStrategy, Palantir, Vistra, and Nvidia. And a lot of people made money on that, including small investors, and of course the actual founders and owners of these companies. For example, Michael Saylor saw his personal net worth grow to over $8 billion from his ownership in MicroStrategy. Jensen Huang, the CEO of Nvidia, saw his personal net worth grow to over $120 billion. Crazy stuff. But just because these stocks had massive gains in 2024, that doesn't mean that they're good buys going into 2025. In fact, it's rarely the case that the top stocks are the best performers in back-to-back years. I would also like to point out that it's very possible to build wealth and even beat the market without owning any of these stocks. In today's video, I'm going to analyze the 5 best performing stocks of 2024. I'll explain why they went up and give a brief analysis on each, then give my thoughts on whether these are good investments going into 2025. Finally, I'll give my ranking of which I think will be winners and which will be losers. Let's roll the intro. My name is Zach. This is Dividend Data. You should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using my stock research tool, dividenddata.com. I asked my AI analyst to screen for the top 5 stocks over the past 5 years, and we got these results. And I'll be using this to do deeper analysis on the companies as well. Link in the description and pinned comment of the video. So first we have Applovin Corporation, ticker symbol APP. This is a US software company which saw a 794% increase over the past year. 794%. And likely most of you have never even heard of this company. As you can see, their stock price just boomed this year. And despite never making a video on it, I actually had this already on my watch list. And the reason why is I saw this company's fundamentals improving rapidly. So what does Applovin do? Their entire business is basically trying to help mobile app developers market and monetize their apps. They help their apps get discovered. They help them adjust and optimize their marketing campaigns and even optimize a company's ad inventory within their app. And when you look at their financials, it starts to become pretty obvious why the company's stock went up so much. And hint, hint, the company's making a lot of money. Now, their top line revenue increased 39% year over year, but the big point here is that their profitability increased massively. In Q3 2024, which was their latest reported quarter, net income increased 300% year over year to $434 million. And you guys know that I think free cash flow is the most important financial metric in terms of the profitability of a business. That increased 182% year over year to $545 million in Q3. Assuming no growth, that gives them a forward run rate of $2 billion in free cash flow. With a current market cap of $117 billion, that means they are trading conservatively at around 59 times free cash flow, assuming basically no growth next year. And that's a bad assumption because if you look at their earnings per share, it is increasing massively. In fact, this rate of growth only accelerated in Q3. And again, I love that this company actually generates cash. You can see that their free cash flow per share is growing massively. In fiscal 2023, it increased 174% year over year, and they're on pace to crush that so far in fiscal 2024. This business also has something I love to see, which is where their largest business segment is also their fastest growing. As you can see, software platform revenue is their largest business segment, currently at 65.3% of revenue over the trailing 12 months since the end of fiscal 2022. So not even 2 full fiscal years, the company has grown revenue in that segment from $1 billion to $2.8 billion. So nearly tripled. Another key reason why the stock is going up is that they are using AI internally. That's both for their internal software development so that they can continue to deliver new products fast. But so much of their business is focused around advertising and optimizations. And one of the most profitable uses of AI right now is in advertising so that they can better connect potential buyers to the product. This is the #1 way that Meta is using AI internally for Facebook and Instagram. And it's the #1 way that Google is using it for Google search and YouTube ads. The company also started repurchasing repurchasing shares, and they authorized a $2 billion share buyback program. Currently, the average price target for Applovin stock is $338.60. That's slightly below the current price of $350, so not even outrageously valued based on analyst estimates. But of course, a lot of this will depend on continued future high growth. So overall, my thoughts on Applovin is that it is a real business and it has very high quality financials. So I would definitely put this in the winner category in terms of it's likely to continue increasing value over the long term. I don't know what's going to happen next year. Obviously, I can't predict the future, but this is at least a good business. All right, and then stock number 2, we have MicroStrategy Incorporated, ticker symbol MSTR. This is a software company that increased 375% last year. And this is basically the exact opposite of Applovin in that MicroStrategy is basically not even a business at this point. They do have an underlying software company, but then has had declining revenues for a decade and only around $500 million a year. And that's top line revenue, by the way. It's not even a profitable business. But yet the stock is valued at $83 billion right now. $83 billion. So where does that value come from? Well, it is entirely based on their balance sheet, which is basically entirely Bitcoin. Over the trailing 12 months, they're estimated to now hold 252,000 Bitcoins, which based on this amount is around $25 billion. And I'm assuming this number is actually outdated because I keep reading reports that they're borrowing more and more money to buy even more Bitcoins, even at the current prices. So MicroStrategy, it's not a business. The entire value is based on Bitcoin. And that's thanks to this dude, Michael Saylor. Since 2020, he basically flipped that entire company around and turned it into a Bitcoin maximalist investment strategy. And they borrowed a ton of money, and they developed this crazy strategy where they borrow a ton of money and it's all leveraged up as well, all around Bitcoin. I recommend you go listen to some interviews with him. It's pretty interesting. But basically, he developed this whole scheme where he's borrowing money against the company's stock. So it's backed by MicroStrategy stock. So he says that prevents it from being margin called because they would basically just issue shares and inflate the stock to become basically worthless. That's in the bad case scenario. Or in the good case scenario, Bitcoin goes to $10 million. Who knows? So all you need to know about this stock is that it's basically a leveraged play on Bitcoin. And if you know anything about my investing strategy or have watched my other videos, you know that I would not want to touch this with a 10-foot pole. I have absolutely no interest in this, and I would put it in the loser category. If Bitcoin goes down at all in 2025, it is going to drop like a rock. But hey, to be fair, there are some bullish signs for Bitcoin. You have the theory that it will become digital gold, in which case that it has room to probably increase around 10 times more in market cap, because then the market cap would be equivalent to around what the gold market cap is. You also have way more speculative things, which Bitcoin is completely speculative. You have rumors that the Trump administration is considering making a strategic Bitcoin reserve. And by the way, if they did that, Bitcoin price would probably surge massively. But all of that is speculation, and I do not want to be anywhere near this thing. All right, so for stock number 3, you have Palantir Technologies, ticker symbol PLTR. This is another software company that increased 367.3% over the past year. And what happened here is kind of like a three-pronged approach. First off, you actually had a real fundamental improvement in their financials and business. Second, you have the advancements in AI, which really helped this company. I'm not an expert on Palantir, but their entire thesis for decades has been that they're going to be this massive data platform and be plugged into all these large businesses and governments and basically help them organize and get insights from all their massive amounts of data. And the advancements in large language models kind of just accelerate that entire thing into more useful insights. And then before I forget about it, 3 is based on story. Palantir has an awesome story about being one of the startup, new government contractors, especially in the defense industry. So with the Trump administration and all the new tech people being involved in the administration, they are expecting a larger and larger share of government contracts to go to innovative new companies that cost much less, like Palantir. And I think that's actually a correct assumption, and companies like Palantir and Anduril will continue increasing their share of government contracts compared to legacy companies like Lockheed Martin, Boeing, etc. That whole cost plus business model, terrible in terms of taxpayers. But yeah, the running joke with Palantir is that nobody actually understands what they do or what their business model is. And I am definitely closer to that camp rather than being an expert. I haven't done that much of a deep dive on the company's business. Well, let's start with the financials. You can see their earnings per share have increased a lot over the past few years. The same is true with revenue per share. Net income has been climbing into profitability, and the company is starting to become kind of a free cash flow machine, which is nice. They've been free cash flow positive since 2020, and they have a very strong balance sheet with negative net debt. That's negative $4.3 billion of net debt. If we take a look at their business, 54.4% is government revenue, $1.4 billion, and 45% comes from commercial businesses, $1.2 billion. And you can see that this is steadily growing over time. For the latest quarter, Q3 2024, revenue increased 30% year over year. US revenue increased 44% year over year, and adjusted free cash flow for that quarter came in at $435 million. And they've also had more positive things recently, like they just increased their full year 2024 revenue guidance to over $2.8 billion, which is a expected 26% year over year increase. And they've also said they have strong demand for their next generation AI powered platforms. But the big problem with buying Palantir stock now is that it's valued at $181.9 billion, which is just a crazy valuation for where the company's at right now. In the latest quarter, they generated $725.5 million of revenue. So if we annualize that out over the next year, that's just under $3 billion. So they are trading at over 60 times current revenue. That's top line. That's not even profits. And we can be nice and say they maybe generate $1 billion in free cash flow next year. That's trading at over 181 times free cash flow. So for this to make remotely sense and see high growth in the future, the company is going to have to grow a ton. You need multiple years of 100% increases. So I would just say at these current prices, Palantir stock has just gotten too risky to buy right now. So even though it's a high quality business and will likely grow in the real world, the stock, in my opinion, is just a loser at these valuations. All right, and then for stock number 4, we have Vistra Corp, ticker symbol VST. They increased 291.99% year over year. Now, I'm just going to be honest here. This is a company I know very little about, but luckily I can ask my AI analyst and it will break down how they make money and what their business is. So they are a retail electricity and power generation company. So they have their different business segments, one of which is selling electricity and natural gas to residential, commercial, and industrial customers. They operate power generation facilities for electricity. They buy and sell energy on markets. They manage risk around those commodities and do logistics. And here you can see their revenue is broken into retail, which is around 50% of their revenue at $12 billion. And then they have Texas revenue at 22%, which is $5.4 billion. East, which I'm assuming means East Coast, at $4.2 billion or 17%. Sunset at $1.5 billion or 6%. I'm assuming that means the Sunset Belt in the US. And West, I'm assuming West Coast at $844 million or 3.4%. And based on what I'm seeing here in terms of revenue, their most compelling business is that retail segment. Since fiscal 2017, that segment has grown revenue from $4 billion to $12.3 billion over the trailing 12 months. So again, a nice thing I like to see here where their largest business segment is the fastest growing. And as you can see, their stock price has just boomed over the past year after being flat for really most of the past decade. And if you look at their earnings per share, you can see some growth, especially in this latest quarter. And that's especially in revenue. Whatever happened in this latest quarter, that was big time. The same is true for free cash flow. They had $8.21 in free cash flow per share in that quarter. That's $2.8 billion. However, like most utility and power companies, they do have a lot of debt. They have $14.9 billion net debt. They also pay a dividend, which is unique among these companies. It's small though. It's a 0.55% dividend yield, and that's about a 12% free cash flow payout ratio. It has grown pretty fast though at a 12% 5-year compound annual growth rate. And as you can see, they basically increase it every single time they pay a dividend. And this is a quarterly payer, so that's nice. And generally this dividend is sustainable based on both free cash flow and net income. So I'm just gonna be honest here. I don't really know enough about this business to give a great take, but my intuition, given its high valuation and kind of outlier results in this latest quarter, my intuition says that this should be closer to the loser bucket. But hey, if they hit these future earnings per share estimates, which analysts have, then they're set for a lot of real growth and the stock price may be more rational. All right, and then finally for stock number 5, we have Nvidia, ticker symbol NVDA, which is up 190.7% over the past year. And this is actually one of the biggest success stories in basically the entire history of the stock market. It's now valued at over $3.5 trillion and now one of the top 3 most valuable companies in the world. Microsoft, Apple, and Nvidia keep switching places over the past few months. And the reason why is basically entirely because of this massive upswing in profits. As you can see, their earnings per share have exploded coming out of 2023. And I'm not going to do a full stock analysis today on Nvidia. I actually did a full one after they reported their last quarterly earnings. So go and watch that. And most of the information is fully up to date still. So if you want a deep analysis on the company, go watch that video. Link in the description and pinned comment, and I'll put it on the end screen. Well, basically what happened, if we look at their revenue by segment here, their data center business just exploded, and that's because of AI demand. So if you're analyzing an Nvidia stock, the entirety of it comes down to how you think their data center business will do. That's now 86.5% of the revenue over the trailing 12 months. And since the fiscal quarter reporting October 2021, data center revenue over the trailing 12 months was $9.2 billion. And in October 2024, that came in at over $98 billion. So that's insane growth over the past 3 years. You can see revenue per share growing up massively. And this is a wildly profitable company with 75% gross margins and 55% net margins. And they also get this all manufactured through Taiwan Semiconductor, so through a third party, so they don't have to build all these expensive chip fabrication plants themselves. So their capital expenditures are very low by comparison, only at $813 million in the latest quarter. And for context, in that quarter, they generated $17.6 billion of cash from operations. And because of that low capex, free cash flow was $16.8 billion. Crazy, crazy stuff. So Nvidia is a free cash flow machine, which is real profits to the bottom line for investors that they could use to repurchase shares, pay dividends, and generally just put them in a position of financial strength for the future, whether it's acquisitions or investing into new businesses. The company now has negative $28.2 billion of net debt. As you can see, their cash and short-term investments have gone up to $38.4 billion. And despite this real high-quality growth, Nvidia's valuation is actually not that crazy compared to the other examples I showed today. They actually trade at the cheapest multiple. But the real question with Nvidia is how you think the demand for that data center business will be over the future coming years. Only time will tell, but for the near future, it seems likely for 2025 and 2026. And analysts are projecting continued growth in earnings per share. And if they hit this through fiscal 2027 and hit that analyst estimate, they're trading at 26 times 2027 earnings per share. So of this group, I think you have to put Nvidia in the winner category, and I definitely am. And of this group, I definitely think it's the safest and most reliable one to have a positive stock return in 2025. So to recap, I have Nvidia and Applovin in the winner category, MicroStrategy and Palantir in the loser category, and Vistra also in the loser, but I didn't really even know enough to have a strong opinion. But you shouldn't really get caught out in this FOMO or fear of missing out that you didn't get into these top names or anything in the past year. You don't have to own the top stocks or get lucky to build wealth in the stock market. I beat the S&P 500 in 2024 and I didn't own any of those stocks. I think I have a much less risky investing strategy overall. And as long as you're consistently investing, even if that's dollar cost averaging into some major indexes like the S&P 500, you will do really well over the long term and continue to build up long-term wealth. For example, me personally, I'm 25 years old and now I have a portfolio of over $310,000 that I've built up. It pays me over $4,500 a year of dividend income. And if you want to hear the top lessons I learned along the way building this portfolio, then click the video on the end screen because I just did a full breakdown of my investing journey. And if you enjoyed this video, leave a like, comment, and subscribe to the channel, and I'll see you in the next one. Thanks for watching.